Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing medical property stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 3.1 billion market cap. They're trading at $5.21 a share, and they have 595 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they have really consistent free cash flow each year. 600 million in 2020, 600 million in trailing 12 months. It peaks in 2021 at 800 million. That's what you really like to see, consistency, because if the company is really inconsistent, it's so hard to predict the future. Net income is the profit or loss on the income statement. It's revenue minus expenses. They had a big number in 2022, over 900 million. It looks like they have a loss in the trailing 12 months. They are a REIT, so they do own lots of real estate, so they could have had lots of write-downs in the trailing 12 months, which is pretty likely because they had positive free cash flow. Write-downs are non-cash items that bring down your net income, but they don't affect cash flow. Like, say for example, you buy a home for $100,000. To make it simple, the example, you pay all cash. So the value of the home is $100,000, that's the appraisal value. So on your personal balance sheet, you have a fixed asset for $100,000. And let's just say you depreciate the asset over 10 years, $10,000 a year. So after 3 years, the value of the house on your balance sheet is $70,000. Because 3 years depreciation, 10,000 times 3 is $30,000. So it's worth $70,000 on your balance sheet. Let's just say something extreme happens. A tornado hits your town, it wipes it out. So the real estate is worth nothing. Nobody wants to live there anymore. You have to write down the value of the asset from $70,000 to zero. And you take a loss on your income statement. You take a $70,000 loss. And let's just say for fun, you made $70,000 at your job. So it would appear you made nothing for the year. Because your income was $70,000, you took a $70,000 loss. So you would pay no taxes because it brings down your net income to zero. But the year you wrote down your house from $70,000 to zero, it's not like you lost $70,000 of cash. You just wrote down the value of the home from $70,000 to zero. The cash occurred 3 years ago when you paid $100,000 for the home. So you can't lose any more cash on the home. That's why impairments are non-cash items, because the cash occurred when you bought the asset. And it doesn't matter if you bought the home with debt. It's the same idea. And if that sounds a little confusing, let me know in the comments, and maybe we could do a live stream one day. And it's a lot easier to talk about over a live stream. Revenue is a rental income for the company, and that's highest in 2021 at 1.5 billion. It's 1.4 billion in the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 6.3 billion. We discounted those numbers back to today's and weighted average cost of capital. We get a value of the company of $5.6 billion. We divide that by 595 million shares. And we get a calculated stock price of $9.33. They're trading at $5.21, so they're trading at a 44% discount. It's a strong buy according to the model. And look how high the WACC is on Finbox, 14%. And it still seems undervalued. There are 17 companies in the same industry as MPW, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $216 million in CapEx, which is between the median and average. Welltower spends the most at $1.2 billion. If it's in a yellow box, that means they have the best ratio out of all the companies. REITs tend to be a bit leveraged because they have to pay out at least 90% of their earnings in dividends. So they need to take on debt in order to fund their growth. They can't do it with excess profit or excess cash flow. MPW is 1.2. For every dollar of equity, they have $1.20 of debt. Look at that yield, 17%. And I did confirm that. That is correct. That's crazy high. What's going on? It must be the stock price came down so much. So they probably will adjust the yield. People invest in REITs for the yield because they tend to pay high dividends. Look at Healthcare Trust, 14%. Welltower is only 2.7%. In terms of free cash flow, they're generating a lot, over $600 million. Healthcare Realty Trust is the highest at $868 million. They rank 8th in market cap. Welltower is number 1 by far, 46 billion. It looks like they should be ranked 7th because they are higher than DOC. They have a really good price to book. Price to book is stock price over book value per share. Book value is the equity in the balance sheet. It's assets minus liabilities. It's the value of the company according to the balance sheet. We can't look at that PE because remember it's negative. A negative PE won't give you a value. Solid price to free cash flow. They're trading at 5 times free cash flow. Really good price of sales. They're trading at 2.3 times sales. They generate 1.4 billion of revenue. Welltower is number 1 at 6.4 billion. But MPW generates a lot more revenue as a percent of market cap. How do you know this? You look at the price of sales. It's a lot lower than the companies above it. They're still growing a lot, 11%, their 5-year annual revenue growth rate. Global Medical is the best at 24%. Let's look at their slides from the third quarter. Here's a visual of their properties. It's mostly in the US, some in South America, a very small amount. It looks like 4 properties, and a bunch in Europe. 441 properties, 55 operators, 44,000 beds in 31 states and 10 countries. When you look at a REIT, you want to look at funds from operations. That's more intuitive for REITs than free cash flow. The simple calculation for funds from operations is net income plus depreciation and amortization minus the gain on the sale of real estate. That's on a high level, but they give a full breakdown here. They start with net income 117 million. This is for the third quarter of 2023. Then you add depreciation of 96 million and then a 3.8 million impairment charge. So funds from operations 216 million. So this is the money that's left over for the shareholders. Most of this gets returned to you, the investor, in the form of a dividend. They also show us normalized funds from operations, adjusted funds from operations. That's just a different view of the number. Like when you look on a company's slides and they show you adjusted EBITDA or adjusted net income, they strip out things like stock-based compensation. You can see they did that here, 10.2 million for stock-based compensation. So funds from operations per share is 36 cents. If you own 1 share, that's your stake in the company. You deserve this 36 cents. Last year for the quarter was 42 cents. On the next slide, they show us their debt and the interest rate they pay in the debt. They have a credit facility that matures in 2026. The interest rate is 5.4 to 6.9%. The balance on that is 1.35 billion. All these numbers are in thousands. They have a 2027 term loan, 7.1%. That's a really high interest rate, 200 million. They have lots of debt. This one's in euros, 360 million. The balance on that is 440 million. An Australian dollar term loan that expires next year. A British pound expires next year. Because they do business in other countries, so it makes sense for them to take on debt in that country to avoid interest rate conversion. Because when they have properties in the UK, so this British term loan is for that property, the ones in the UK. But this 2027 term loan is a killer, over 7% interest. Hopefully rates come down and they can refinance at a lower rate. The weighted average rate on these loans is 4%, and they have 10.2 billion outstanding. Most of it is fixed rate, which is ideal, 85% fixed rate, 15% variable rate. Here's a different view of their debt, the 10.2 billion, a breakdown by year. 30% of their debt is due in 2026, 3 billion due then. Not much due this year and next year. Half their debt is in US dollars, 1/3 in pounds, 13.5% in euros, and only 3% in Australian dollars. This is likely a breakdown of their exposure. So they probably have roughly half their exposure in the US, 1/3 in the UK. Maybe not exactly, but I'm sure it's fairly close to these numbers. Let's look at their portfolio, their properties. 431 properties. The base rent is 1.3 billion. 18 million of that matures this year, 2.7 million next year. 88% of their properties mature after 2032. So they have a pretty good runway of rents. Assuming the companies that are renting their properties stay in business, they're pretty much locked in for at least another decade. Here's a nice little view of their rent by year. 88% is locked in until after 2032. 5% matures in 2032. So the rent that matures this year, those people probably signed an agreement 5 years ago, maybe 10 years ago for the property, and now it's maturing this year. So maybe they'll renew another 5 or 10 years, or maybe they'll just leave the property and MPW will have to find another lessee. Here's a breakdown of the businesses that are at their locations. 72% of the properties are general acute care hospitals. 16% are behavioral health facilities. 9% are inpatient rehab facilities, and a small amount are long-term care acute hospitals and freestanding ER urgent care facilities. So their revenue by asset type, 72% of their revenue is from general acute care hospitals. Their largest lessee is Steward Healthcare. They control 2% of their assets. Then Circle Health, 1%. So they're pretty well diversified. They have lots of companies leasing their space. Here's Steward Healthcare. They have 36 properties in Florida, Texas, Arkansas, Louisiana, Massachusetts, Arizona, Ohio, Pennsylvania, and Utah. They're also pretty diversified, that company. Even if a few of these companies defaulted and weren't able to pay their lease payments, it would still be a pretty small percent of their total portfolio. Because even the biggest company, Steward, only controls 2% of this company's total assets. Here's a breakdown of the assets and revenue by state. Texas is the biggest state, $2 billion of assets, 11% of its revenue. The revenue in the third quarter from Texas is $40 million. In all the U.S., it's $239 million. So the U.S. is about 67% of this company's total revenue, then the UK 1/4, then a bunch of other European countries. So non-US is 1/3 of their revenue, US is 2/3. In terms of assets, it's a similar breakdown, a little different. 62% of their assets are in the US, 38% outside the US. And of course, UK is the second biggest at 22%. That's why we saw so much debt to the UK. This slide shows their EBITDA ARM rent coverage. Earnings before interest, taxes, depreciation, amortization, rent, and management fees. So this slide is EBITDA ARM over rent. It's how well they can cover their rent payment with their profit or their EBITDA ARM. General acute hospitals are in the best shape at 2.8. They could almost cover 3 times. Even in the worst situation, long-term care acute hospitals for the current quarter is 1.4. At least they can cover it. But you do want a little more spread, a little more cushion. Because if it falls below 1, you lose the money. They have a solid EBITDA ARM coverage ratio for Steward Healthcare, 2.7. Some of these are above 7. So their EBITDA ARM can easily cover the rent. EBITDA ARM is obviously not used in most industries, because most industries don't have rent and management fees, unless you're a property management company like this. They have $446 million of investments, $50 million in PHP holdings. PHP is a managed healthcare company, so in a similar industry as this. Here's a summary of their current projects. IMED Hospitales in Spain, that's a $45 million commitment. They spent already $43 million. A location in Texas, 2 more in Spain and another in Texas, with their biggest client, Steward Healthcare. That seems to be a big project. The commencement date is in a few years, in 2026. So they have to wait until then to start receiving rent from Steward. It looks like they're preparing the properties now. Let's look at the income statement. So revenue for the quarter is $307 million. Most of that is rent, $229 million. Another $21 million of rent. They also have financing leases, which is pretty much the same as rent, $26 million. And interest and other income, $30 million. Because some of the hospitals have bought the real estate from them, and this company funded that sale, so they're collecting principal and interest payments from that tenant or from that customer. And then they have a bunch of expenses. Some of the properties they purchased, but not all cash. So they have a mortgage, they're paying interest. Then of course, lots of depreciation. They have payroll and other fees, $38 million. So net income, $117 million. This is their funds from operations slide. Remember $117 million? That's how you calculate funds from operations. You start with net income and depreciation and amortization. So their EPS is 19 cents. Most of that they pay out in dividends. So the dividends per share is 15 cents. That's the rule. If you're a REIT, you have to pay out at least 90% of your earnings in dividends. Shares outstanding is pretty flat from last year, 599 million to 598 million. Here's their balance sheet. They own 13 billion of land, buildings, and improvements. They have 340 million of cash, 1.5 billion of investments, another 1.8 billion of investments. Total assets 19 billion, a little less than last year. They have lots of debt, $10 billion. They raised $8.6 billion from selling stock. They have a retained deficit because they pay out so much in dividends. Remember, retained earnings or retained deficit is a sum of all companies' prior net incomes minus the sum of the dividends they paid out. So lots of REITs have a retained deficit, but that doesn't mean they don't have positive cash flow. The reason they have a deficit is because of all the write-downs, all the asset impairments, the depreciation. And if you want to learn more about the companies they're invested in, PHP Holdings, they own about half that company. The investment is $684 million. Steward Healthcare, they have a big investment in them. That's their biggest tenant. They own about half of International Joint Venture. And it looks like International Joint Venture is paying this company 7.5% interest on the loan on their investment. Let's take a look at the company on Simply Wall Street. Its last price, $521, 3.1 billion market cap. Up big in the past week, 11.5%. Down really big in the past year, down 60%. Let's learn a little more about the company. They're a self-advised real estate investment trust formed in 2003 to acquire and develop net leased hospital facilities. What net lease means is that the lessee pays the interest, taxes, fees, all that stuff, in addition to the rent. It's a really common thing in commercial real estate. They usually call it triple net lease. From their inception in Birmingham, Alabama, the company has grown to become one of the world's largest owners of hospital real estate with 441 facilities and 44,000 beds as of September 30th, 2023. Lots of companies in this industry use the term beds because that's an indicator of how much property you own. Because one property can have 100 beds or 100,000 beds. So if I say I own one property and you own one property, you can't really understand the scope. If I say I own 100,000 beds and you control 100 beds, now we have an idea of who's bigger. Since the end of the third quarter, the company has sold 4 facilities and now owns approximately 43,000 licensed beds in 9 countries across 3 continents. The continents, North America, South America, and Europe. Their financing model facilitates acquisitions and recapitalizations and allows operators of hospitals to unlock the value of their real estate assets to fund facility improvements, technology upgrades, and other investments in operations. It looks like they started trading in 2005 at $10.50. Their lowest point ever was in 2009. It fell below $3 to $2.91, and it's getting close to that point again. They did really well from 2009 to 2020, peaking at $24. Then COVID hit, and it dropped to about $13, then ran back up again over the next couple of years to $23, but it's been getting crushed lately. But even if you bought it here, say in 2007 at $16, and then 12 years later you sold it for $16, that doesn't mean you broke even. You probably received 7-8% in dividends. So you didn't do that bad. But it seems like a great time to buy it. It's getting close to trading at its all-time low. It hasn't traded below $5 since 2009. Simply Wall Street values them at $10. They say they're 49% undervalued. 11 analysts priced this stock at $7. Their revenue for 2012 was $201 million. And look how much it's grown over the years. It peaked at $1.6 billion. That's a 700% growth in a decade. It has come down to $1.4 billion. I guess that's why the stock price is coming down a lot. But still, $1.4 billion is a lot more than $200 million. Remember earlier we were looking at the stock chart, and I showed you the current stock price is the same as 2009 levels. So let's say 2009, they also had $200 million of revenue. It's probably lower, because it was 3 years before this. So when they had $200 million of revenue in 2009, they traded the same stock price as $1.4 billion of revenue today. So just looking at that, it seems really, really undervalued. Or it was really, really overvalued in 2009. But I don't think so. I think it's just really undervalued today. And the forecast is for their revenue to be flat the next 3 years, hitting $1.3 billion by 2025. This red line is their debt, and it was $1 billion in 2012, peaked at $11 billion in 2021. It's currently at $10 billion. When you layer in the blue line their equity, it's pretty close to their debt. It's currently a little less than their debt. So their debt to equity ratio is 122%, or 1.2. And when you put in a green line, they don't have much cash. because when cash comes in the door, it goes right back out towards expenses and dividends. So not much left is sitting there. This purple line is their annual dividend payment. It was 84 cents in 2014, currently at $1.16. $1.16 in the middle of 2023, they cut it to 60 cents. The forecast is 72 cents by 2025. But look at their yield. It was 6% in 2014. It was 5% in 2021. Look how high their yield was, 13%. But they did cut their dividend. But the yield is still 11%, even though they cut their dividend. And the forecast is for the yield to be 14% by 2025. So something's got to give. Either the stock price goes way up or they cut their dividend again. Because 14% is too high. If they were paying a safe 14% dividend, everybody will put their money into the stock. 77% of the company is held by institutions, 21% by the general public, and 1.5% by insiders. Vanguard is the biggest shareholder at 14.5%, BlackRock 11.5%, Schwab 1.5%, Cardinal Capital 1%, Co2, the San Francisco company, 1%, the CEO 0.7%. REITs don't really need to employ a lot of people. Their employee count went from 33, it's currently at 119. And the ticker trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Mexican Bolsa, Bulgaria, and the Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.